Greetings, everyone. Oh, excuse me, frog in my throat. This is your week 3 lecture for chapter 3. So, given that this is a holiday weekend and we're not going to have our normal class time, I thought I'd do you a quick lecture on key points for chapter 3. Agenda is fairly quick this week. We'll go over the assignment beta review and then go over the chapter 3 exciting PowerPoints, which is one of the more important chapters because it sets some very key concepts for what happens in future chapters that we're never going to leave before. So the stuff you learn in chapter 3 will stay with us right to the end because it involves time value of money. So first, let's hop over to see the homework beta. Now then, chapter 2, back on page 65, our first one was 2.3. And this is another one of those marginal versus average cost ones, and they give you something similar to that problem we had last week with 2.1, where we got 200 hours of free service over the first year. Additional time costs $100 per hour. So at different levels of utilization, they give you A, B, and C, which do, what do your marginal and average costs work out to? So on my screen, these are the 3 levels, A, B, and C, 125, 225, 325. Average cost and marginal cost. Free hours, $200, additional hours, $180. Now, part of it, when you just see additional cost per hour, they give you part of the answer right now for marginal cost. But for the quantity 125, your average cost is 0 and marginal cost is 0. No real calculations here. Why? Because, well, we know we get 200 free, 125 less than 200. So average and marginal cost are both 0. Now, 225, we then have to worry about what it's going to cost us because we've gone over that threshold of the 200 free hours. So the first 200 are going to be free and 25 is going to be charged. So average cost, write it here, is basically say, let's take the 225, minus the 200. So we get 225 they're actually being charged on. That $225 is charged at $180 an hour. And you divide it by the total number of hours. So you've got basically 25, because that's the amount above 200, times 180, which is the rate. And that gives you your average cost of $20. Marginal cost, the cost of every additional hour is 180 by definition. They say in the problem, it costs you additional time, costs $180 per hour. So each additional hour, the cost of one more hour, the cost of going from 225 to 226 hours is another $180. Similarly, see on 325, we have really the same problem as part B. We know we had 200 hours free, so we're going to be charged for 125 because 325 minus the 200 free hours is 125 hours that we're going to be charged for at $180 an hour. Same math as the before. So basically taking that 125 times 180 divided by the total number of hours. And if someone messes up on this question part A or B, it's usually because even though they use the 125, which comes from 300 minus 200, to multiply the total cost, you're still averaging it across the entire quantity of hours used. So you generate your cost at 125 times 180, and then that total amount is then divided by 325 to get your average cost. And that's why after I get that minus the total amount used minus the amount for free times the rate, 180, I divide that whole thing by the total number of hours of 325. So don't get trapped and say, oh, I only divide the cost by the amount we're charged for. You're dividing the cost by the total amount used, whether it was free or charged for, to get the average. Similarly, as last time, marginal cost, there's really no calculation on here because they told us right up front, every additional hour costs $180. So it's going to cost us $180 to go from 325 to 326, or from 3 324 to 325. Every hour costs us, by definition, 180. Okay, enough of that. Next problem is 312. This is the one where it gets a little tricky, and it actually seems a little more complicated than it is initially, because they give you all these little stats that you have to add up. And this is an attempt to get you to look at all the talk that we've had about in chapter 1 and 2 about fixed costs, variable costs, where all the costs from, so you can identify them and quantify them all in the right way. Now then, here's what I did. Aussie Chocolate Company. They give us a sale price per bar. How do I know that? It states that in part A. Cool. Fixed costs per year. 250,000. How do I know that? It tells you right there. Adding production line devoted to this new candy we're talking about making costs $250,000 per year. That $250,000 a year is fixed because you get charged that when you make one candy bar of the new type or 200,000 of the new type. It costs $250,000 whether you're just sitting idle or making 200,000. Variable cost is materials per bar plus labor per bar. Okay, now then, they ask you to do things is break-even point on part A. And then on part B, they give you what's the profit at this price and so many bars. Now then, and I didn't actually do part C, although some dedicated people actually do it. Now then, break-even point. That's when your total costs and your total revenue equal each other. So what I had to do is come up with variable cost per bar. Well, they give it you there. Chocolate, 25 cents a bar. Sugar, 0.0 or 2 cents a bar. 3 cents a bar for mint. Labor is 15 cents a bar. All variable costs. Variable costs, because they vary depending on how many bars you make. Sale price is 140. Total variable cost is 0.45. Difference in that is 95 cents. Now then, since this is what we know, we have a sale price of 140. So the revenue we bring in is equal to 140 times, say, X bars. We don't know what X is yet. We're going to find out. But we also know that because of the cost we had figured out per bar, it's 45 cents per bar plus fixed costs. Total cost is fixed costs plus variable costs. So 1.4 is equal to 250,000 plus 45 cents a bar. Actually, you should probably have an extra X, that 0.45 cents is per bar. So when 1.4 times number of bars X is equal to 250,000 plus 45 cents times that bar X, 45, that 45 is the same as that 45 when I'm moving my cursor against. You do the math. So you solve for X. So you got your 0.45 X and your 1.4 X is equal to 0.95 times X is equal to 250,000. So divide your 0.95 and your 250,000 give you that 263,158. And this is just where you do a word problem to get that break-even point. Figure out what your total revenue is per whatever it is you're making. In this case, candy bars. $1.4 for every candy bar is your revenue. 250,000 times or plus 45 cents for each bar sold. So you have your revenue calculation with a common factor called number of bars. Your cost factor. It also has something expressed only in number of bars. You solve for X, 260,158. Cool. Now then, part B. They give you production line and say, okay, reiterate at 140 cents a bar or $1.40. What's your profit at 270,000 bars? Well, the revenue is easy. 270 times 1.4 bars is $378,000. Total costs. Your fixed cost doesn't change. Your variable cost is equal to 45 cents times the number of bars. We have the variable cost of 45 cents. We have the number of bars at 270,000. So you do the math. Fixed cost doesn't change. Variable cost, we just calculated. Total cost, 371,500. Revenue minus costs is your profit, $6,500. This is one where the answer is in the back of the book was wrong because the lazy professor who wrote the text did not change his answer from the previous edition. And he changed the number on this question. Sneaky thing professors do when they do new textbook editions because they want to force you to buy the new one. So they changed the answers and the questions slightly. Even though this question had the exact same format in the previous two editions, it had slightly different numbers. So your profit here is what you're being asked for is $6,500 for that $270,000 in bar. If you want to see for different values, you can always just type in like, oh, what would make it 300,000, 35,000. It just does the math. So that's 2-12. Next one is 218. This is the one where you're looking at different machineries with fixed costs and annual variable costs. And you're looking at three alternatives. And you can figure out on these three alternatives, at what point of production is each one profitable or not profitable, and which is the most profitable. So here's what I did. First thing I do is put the dollars out there just on the table they put in there. Again, if you don't do your design exactly as I'm doing mine, that's okay, as long as we can tell what you're doing and how you're doing it. So I did a number of units and the cost of each period to figure out where our costs were overall. Now then, at 0 units, everything is just your fixed cost, straight across. Now the tricky part here is figuring out exactly what units to use. Now what I did is I actually started this off and just put some numbers like, I think I started off with like 5, then 10, and I start to see when in the middle there, and you do actually do the math in a very complicated way, like these are the formulas for the math that come out to that. But I also get in the ranges and saying, okay, where do things start to get close? I basically had like a $4,000, and I put a 5, then I had a 7, 10, and I knew that somehow there was a cross point of costing where two ones would equal each other. Because generally, when you have different cost structures, at some point, you're going to want to make A, B, or C at a certain volume level based on fixed costs compared to variable costs. The one that becomes most profitable might change. And that's where the graph part here, which gives a lot of people the more trouble if you can do a graph on this problem. The graphs show it nicely, but you didn't have to do this as a graph. Other thing was, I created on these formulas down here, this A and B and C. You could have done them between all of them if you want, but I found that there's a very quick crossover points at certain things. So you kind of do the math here. What are the variable costs for A? Well, we know that A has a fixed cost of $70,000 and a cost per unit of $14. 14x plus 70,000. This is not unsimilar to that calculation we did on the chocolate bar question. What's the cost of B? Well, $7 per unit, or in this case, X is the per unit, $115,000 in fixed costs. So when do A and B equal each other? Well, 14x plus $70,000, the cost structure of A, $7 plus $150,000. B, when do they equal each other? 6248.6. Cool. This is where we get back to our old rounding issue, because we had that show up on week 1 homework with that hotel occupancy problem, where depending how you rounded, it gave you a different answer. Are you really going to do 6248 0.6 units, you're going to do 8 or 9. Okay, so there's, the real world, I can argue it's going to be around 6429. Depending whether you round up or down, you might get a slightly different answer. That's the way it works in the real world. Mathematics gives us this perfect answer. Real world says we don't make half a unit of whatever it is, just like you don't rent half a hotel room. At least not in America. In Europe they do. B and C, okay, I did A and B, so I just B and C for the next one. Could I have done A and C here as well? Sure, same thing. Makes you feel good. We have that same 7x plus 115,000 for the cost. C, 4x, 4 times each unit, plus 150,000 flat rate. Solve for those. Okay, you get 11,666.7. In real world, are you going to make 7/10 of a product? Maybe not for our purposes. So when you look at that crossover level for A and B, which is, or B and C, which is here, okay, it's going to be either 666 units or 667 units if you do that. Now, if you really want to get into some complication, we can get into cost accounting where you can measure work in process units. We won't go there today. So that's why I found out crossover points. So here's a graph, option A, option B, option C. And what you should see, if I did my graph well, is you have A down here at lowest cost up until you get to a certain point where, oh, A starts going up. Okay, in that case, B down here, at this point, 6429, is that 6429? The costs equal each other, and then B starts actually being cheaper because of the difference in cost. And it's a combination of cost per unit versus your fixed costs and how those ratio to each other on production levels makes these different levels at different intervals. So from B up to here it goes pretty well. And A is just getting out of sight for the cost. So really at this point, B and C are competing. C, this gray line, is still a little bit more compared to B. But at this point, there's another changeover because we figured out when the two are going to be equal over here. So this 11,667, they equal each other, and actual B starts getting a little more expensive. C has a very high initial cost, so it makes it the most expensive at low volumes, but has the lowest per unit cost. So when you get to higher volumes, it actually becomes cheaper on a per unit basis on average to make C after we get to higher volumes. And that's the whole thing. Higher fixed costs make the small volumes more expensive, but then the lower unit costs on variable costs over time, when you get big enough costs, it actually, the impact of the fixed cost is less in magnitude as you get higher and higher volumes. So if you had a slightly different table, if you did this for every 1,000 all the way down to come up with a rough area, that's fine. I start off with some stuff, then when I knew the ballpark, I solved for this to figure out, oh, okay, then I just type this in. Because all this does is do the same thing as before, multiplies fixed, the per unit cost times the number of units, and adds the fixed cost to it. And it does that for every square here. So that was 218. Next one was you're jumping up to chapter 3, which this one is on page, I've got my book out, so you can say, should have bookmarked this. Page 3.2. This is a foreshadowing to chapter 3. Now then, this is one of the more simple problems. Says it's a simple interest problem. A student borrowed $2,000 from her parents and agreed to pay it at the end of 3 years, together with a 5% simple interest. Their simple interest is that it's not compounded, which we'll talk about more in the lecture. So essentially you have the payback in 3 years, and that's where we see this format starting to come up. This format of numbers is something the book uses. I've started adapting it when I work out my problems because it's consistent with the book, but it's a great little mini chart to start all your compounding problems with because it basically lets you think about what you know. In this case, we know an interest rate. We have a number of periods called 3 years. We don't have any interim payments we're making because we're not paying it till the end of it. So we have $2,000 we borrowed today, and in some future time, called 3 years, we're going to have to pay it back with interest. Principal is 2,000. Interest is, all I did was say 5% times $2,000, which is the principal we're going to have to pay back, times 3 years. So every year, because it's simple interest, not compounded, every year we pay 5% on 200 and accrue that interest. So which basically works out to $100 per year. So at the end of the 3 years, we're going to have to pay our parents back 2,000 plus 300 to get 2,300. Now this is a quick foreshadowing. I did a compounded calculation to show you what difference it can make. And this basically said, okay, if we compound the interest and didn't just say simple interest, what would the difference be? We'd owe an extra $16 because I used the compounding factor on page 640 for 5%, 3 years compounding, that FP factor they show on that page. Again, this doesn't come up until next chapter, but chapter 3, but this is chapter 3 problem. I just said, okay, what if it was compounded? You end up paying more money. Statistically, it can add up. So that's the homework problems. At this point, I usually say, any questions? So I hope there aren't any. So I'll close this and say save. And now we're going to move on to chapter 3, interest and equivalence. This, as I said before, is one of the more important chapters because the techniques we're using in terms of compounding and time value of money won't leave us ever. The stuff in chapter 3 we're going to use forevermore, so it's important that we understand it and use it. Now then, interest. Stuff we're going to talk about, how you compute cash flows, time value of money. We'll never leave time value of money. Talk about equivalence. Equivalence is when we're going to talk about how you equate money owed or receiving in the future compared to its value today and vice versa. Single payment, compound interest formulas, and then nominal and effective interest rates. Cool. So what we need to know, the distinction between compound and simple interest, cash flow equivalence, solve problems using single payments, and solve problems using spreadsheet factors. Say that 3 times fast, spreadsheet factors. You actually learn 3 ways of doing these calculations. One is called Excel, which should become everyone's best friend soon. One is called tables at the back of the book. And one is called the detailed math equations, which when I was a grad student, they made me work out by hand because our professors hated us. No, just kidding. But now spreadsheets are our best friend. So money, why do we care about money? This is a class in engineering economics. Economics is about money or things that have traded value. Here's some examples of money. You got some denaries, Roman denaries, British pounds, $20 bill, and a block of salt. I always like to throw this in here. It's one of the biggest monies we had for years, for thousands of years, was salt, because it was so valuable. Salt was traded as a currency throughout history, and Romans were paid in salt overseas, Roman soldiers. That's where we get the word salary, which translates to Latin, which means root salary, because it was a lot easier for the Roman legions to carry on salt than it was really heavy gold. And it was easy to trade. Salt routes throughout Africa and Middle East were set roads that we still follow to this day. And so it was a common thing that everyone could understand. You didn't have to worry about the purity of it compared to, say, gold and how much copper you mixed into it. So it was a great way to see, a commonality that people could use to trade for something else. That really is what money is about. It's a common item that we can trade back and forth, and we can agree that so much of this thing called money will buy so many pounds of apples, or so many days in a hotel, or so many whatever you got. It's a commonality of trade. So, money and time, that's the biggest thing. We make the premise in this chapter that money and time have a relationship where the amount of time that you have money or wait to receive money impacts the value of that money. So it brings the old question of, would you rather have $1,000 today or receive $1,000 10 years from today? The theoretical answer that we want in the classroom, everyone shout out today. Why? Because today you can use that money to make more money, or you can use it to pay something else. In 10 years, who knows what the world's going to look like and how valuable it will be, and whether you care about the difference in that 10,000 10 years from now. So you can do a lot more with the $1,000 today than you can with the unknown that will happen in 10 years. So, cash flow example. Here's where we're going to start cash flow diagrams, and we did this a little bit at the end of chapter 2, and we're going to start now on it more and more so that you just do it in your sleep. O&M costs of this machine for $30,000. Operating and management costs. People often use that as the overhead term. $2,000 a year. Savings. You're going to save $10,000 a year on your operations, whatever it is. Doesn't tell us what we're doing, but we're making that magic thing that everyone calls widgets, that mythical product. And at the end of 5 years, when you assume this machine is not going to be worth it anymore, it has a salvage value of $7,000. That means when it's done with its useful life, at the end of your need for it, you can sell it, whether it be for scrap or to someone who needs it more than you do and refurbishes it. You can sell it, that $30,000 machine, in 5 years, you can sell it for $7,000. So, cash flow diagram. Here's what we might do. The book loves these line drawings with a 0, 1, 2, 3, 4, 5, and up and down arrows for meaning cash out versus cash in. They've always annoyed me, but they're a textbook staple, so I will talk about them here. So here's an example of what we just described in the previous page. We have costs. Well, at year 0, called today, we're going to have to pay $30,000. A new machine, $30,000. Every year, we're going to have to pay another $2,000 a year to keep it going for 5 years. That $2,000 there is that $2,000 a year. We're going to save $10,000 a year from previous operations without the machine. Well, that's the savings here, because we get $10,000 a year that we're not going to have to spend. And then at the end of 5 years, we can sell that machine for $7,000. So the net of all those cash flows is year 0, $30,000 output, plus $8,000 net input, cost you $2,000 to run it, but you save $2,000 with it, $8,000 for every year. So last year jumps to 15, because not only are we saving that $10,000, at the end of the year, we're going to sell it for 7. So we get $15,000 net. And this is basically the nomenclature we're going to see a lot for cash flows. If you use a minus sign here, instead of my parentheses, I like to use the parentheses with red colors because it shows out properly. This is the thing where you got to make sure you're clear, because if you intermix your signs inappropriately, you get really bad answers. So, money can be leased or rented, and we pay with it something called interest. When you lend your money to the bank, you get interest. If you have a checking account that has interest-bearing account, it probably pays you 0.0000001% per month. So mine feels like. They pay you to keep your money in the bank because they're using it while you got there. Like if you borrow money from the bank, you're going to pay for it in terms of interest. That is the price of money, interest. So you put $1,000 in the bank at 4% interest for one time period. Could be a year, could be a month, whatever we're saying it is. Most often we talk in years. So if you're not sure, say years. So for one period called a year, you'll receive back your original $1,000 at the end of that loan, plus $40,000. Or should be plus $40. How do we get that $40? Well, at the end of 1 year, we put in $1,000 and they pay us 4% interest, 4% down here, that 0.04. So $1,000 times 0.04 is $40. So at the end of that year, when you pull out money, the bank will give you $1,040 instead of just the original $1,000, and that $40 is the money you get paid by the bank for allowing them to keep it in their bank and use it for other things. That is simple interest. So that same thing in terms of nice complications. P borrowed for n years. Total interest owed on the original sum. This is simple interest. We'll talk about compound interest in a bit. Simple interest means at the end of your period, whatever periods you have. Present sum of money, P, whatever you're putting in the bank now. Interest rate, in this case, our example is 4%. Number of periods, in this case, say 2 years. Well, if you're going to have the amount of interest you're going to make on that $1,000 you put in the bank for 2 years is $1,000 with times 0.04 or 4% for each period, 2 periods. So 1,000 times 4% times 2 is $80. 1 year was $40, 2 years is $80. That's what we do. And that was the same as that example we had on the homework beta, same type of calculation on that, what, $2,000 you borrowed for 3 years at 5%. That's simple interest. So for simple interest, for loan of $5,000 for 5 years at simple interest rate of 8%. So in this case, you're getting the loan, $5,000 a year, or $5,000 for 5 years. You're going to pay it back in 5 years. At a simple interest rate of 8%. Your P, your principal, is 5,000. I, your interest rate, is 8% or 0.08. N is 5. Total interest owed on that loan is $5,000 times 8% times 5 years, which is $2,000. So at the end of that loan period of 5 years, you're going to have to pay back the $5,000 plus $2,000 in interest, which equals $7,000. That's expensive money. Simple interest calculation, straight out of the book. Now what gets people is the compounding interest. Now, compounding means that rather than just say at the end of this period, we're going to do a calculation then, compounding means you do ongoing interest calculations over a period determined. So if it's over a year and you compound it every month at 12%, well, that works out to 1% every month you're going to have to calculate. And that increases the balance on an ongoing basis. So you have this nice mathematical series summation. Principal times 1 plus the interest rate to the power of n, the number of periods you're borrowing from, minus the principal to calculate the interest. In this case, $1,000 times 1 plus 4%, working out that same example, squared minus the original sum is $81.60 of interest for that period. Now then, compound interest is that for every period in that 5 years, we do an interest calculation and we add it to the existing principal. So, if you borrow it today, think about those cash flow diagrams. We borrowed it at year 0. Now we're looking for F for future value, F for future. For 1 year from now, well, we're going to owe $5,000 times 1 plus 0.08 or 8% to the 1 power, or to the 1 that we said. So at the end of year 1, because we're compounding it every year, your total loan amount is now $5,400. That's where compounding makes us rich if you're a bank. Now at the end of year 2, you're actually, typo here. I should say 54. At the end of year 2, you have your previous balance times 1 plus that's the 8. So it's another 8% on the previous year's balance. Then, I'm going to make this correction quickly on the fly here. This should be 4, bad professor, and this goes out to 5832. Now you have the correct one in this PowerPoint. So at the end of year 1, it's 5,400. So to get the end of your loan balance at the end of the next year, you take your ending amount, which is year one's principal plus interest, and then take that and multiply it by 8% to get the total amount for that year that is now your balance. Third year of compounding, you take last year's ending amount, loan plus interest, $5,000 loan, $832 interest, and take that, and that gets another 8% calculation on it, which now brings your loan balance up to 6,299, and then you do it for year 4 and year 5, and that's where at the end of that time, your loan gets really expensive and a lot more than the $7,000 you had to pay back on the simple interest calculation. Compounding, where you do that at the end of every year, is why compounding is both popular if you're a bank and a lot more expensive. Simple interest is magnified as the number of periods over time increases. This is the way car loans work generally. This is the way the mortgages work. It is the norm in money and lending. So here's a bit of that diagram, and I put it in terms of the nice little charts we talked about at the beginning. At the year of principal is $5,000, you borrow it on year 1 or year 0. At the end of year 1, you get 8% times that, which brings your total loan, principal and interest to $5,400. Year 2, it jumps to 8032 or 5832, like we talked about before. 3, so the end of your loan period, after 5 years, compound interest at 8% is 7,347. The simple interest at the end of that time was just even $7,000 because you didn't have compounding. So the compounding gives your loan an extra $347 that you're going to have to pay back at the end of that time. So here I put it again in that format. You're going to see a lot in the book going forward. So that's your future value. So this actually is an Excel calculation. You can do it on a table as I did over here, one calculation at a time and add it all up, or you can do it in terms of a table and a calculation in Excel. And here's how I get it. You have something called a future value function. I'm going to get more into this in a few slides from now, but I'll just give you a foreshadowing now. If you set up your stuff like this, you can put a formula in that says, give me the rate, give me the number of periods, your rate is there, your number of periods, N is there. The payment you're not making anything until the end of the loan, so it's 0. Present value of the loan is $5,000 when you bought it. And you put all that and say okay, and you get that 7347 calculation. Cool. One thing I say now, this field down here, ignore it for now. It does have a purpose. We don't use it often. I will talk about it later. Let's not complicate it now. But I always get a question when I show this in classes, say, what's the type mean? For now, ignore it, pretend it's not there. I will get to it, leave it blank. So this is the way you can do it. We've now shown you a manual calculation way and an Excel way to do these calculations. And this is, again, you're looking for the future value, meaning how much you're going to have to pay back in the future based on $5,000 borrowed today. So this gets into equivalence. And this is where we're saying, in this example, the equivalence at 8% of $5,000 in 5 years is 7,347. Those are equivalent. $7,347 in the future, 5 years, is the same as $5,000 today at 8% interest. And that's where the interest rate is so huge, because the bigger the interest rate, the more the compounding factor comes into play. And this is used throughout all economic decisions to say, okay, if I have to make a decision with this money that I have today, what do I do with it? Can I do with it? Does it make sense to sit on it and do nothing and wait for the interest to get back and loan it to someone, or do I actually invest it in somewhere? These are decisions that come into play. So notations on this. We're going to use this a lot. I, small, usually italicized I, is the interest rate per period. N is the number of periods. Now, the number of periods might be months, years, whatever it is. So you have to make sure your interest rate and your N, your I and your N, are in the same time frame. Is it an interest rate per month you got? And number of months? If you're given one in years and one in periods, so if you're given your N in years, but your interest rate is compounded monthly, you're gonna have to put those in the same units, which we'll talk about in a bit. P, present sum of money. The book uses the term present worth, which is in vogue nowadays. All the Excel and old fogies like me still say present value. Someone sat around at a finance conference in the 90s and said, no, it really makes more sense to call it worth. Since often we deal with things that are not money valued, but are money equivalents. So present value, future value. If you have the present value, more than likely you're looking for the F, the future value. If you know what the value is going to be in the future, then you're looking for P as in what does that future money that I'm going to get equal today, equal as an equivalence. So you have these basic equations, and this is where we have three ways of doing stuff. This equation, if you have the future value of something on this first one called the F, you can find the present value by taking the future value and dividing it by 1 plus the interest rate, all to the power of the number of periods. This is what we started doing. The one we did down below is what we already did on that $5,000 interest calculation. We found the future value of $5,000 was equal to 1 plus I to the power of the number of periods. Now then, you have these other things called future value and present value interest factors. These are tables in the back of the book, which I'll put up an example of in a moment, that say, hey, if you multiply this principal by this interest factor, and there's a nice table where you can line up periods and interest rates to say, okay, so many periods down at this interest rate, here's a factor I might multiply against my future value to figure out what the present value is, or a factor the value multiply against my present value to figure out what it's going to be worth in the future. Last one is Excel functions. My advice is you can do it if you want to do your homework in manual calculations or using the factors in the back of the book or Excel. It's up to you, but I recommend you make Excel your friend because it's going to be a lot easier. So you have a function called PV, present value, where you can stick in the rate. And I gave you that future value one a few slides ago. You put in the rate, number of periods, payment, if any, and the future value. And by then you can find out what the present value for any given interest rate and any time period. Now then, you also have the same thing for future. You have a future value rate, which is what we did in that calculation I just showed you, where I put in the rate, which was 8%, number of periods, which was 5, no payments because we're not paying anything back before it's due, and the present value, which was the $5,000 we bought. By telling we borrowed $5,000 for 5 years at 8%, that gave us the future value of $5,000 that you have in your hand today at 8%. So here is some nomenclature, just get used to what we're talking about. Again, present value. The book often says P, future value, F, uniform series, A. We'll get into this, but it's an annuity, which basically means if, say, if you were given $100 a year for 5 years, what's the present value of receiving that same amount of money at a certain interest rate for 5 years today? And you can do it backwards for the future. That's where the payment comes in. A is for annuity, which means a standard amount you're going to get paid for every time period, months, years, days, in some cases, if you're into international bankings. Interest rate, we talked about number of periods. Each one of these is a calculation formula in Excel on these spreadsheets where you can figure out whatever you need. If you need the number of periods, you might say, at 8%, how long will it take me to pay off $5,000 if I borrowed it today and had to pay it back at 8%? How many years would it take me? Well, you can put in the amount you borrow and the interest rate, and with the factors you got there, it'll tell you, oh, it might take you, 4.5 years to pay it back, depending on your interest rate. So these are all recommended spreadsheet formulas. I'm not going to force you if you want to do everything manual with either the formulas that the book goes through or the present value factors, which actually can be simpler for certain types of problems we'll talk about. I don't care which, but if you learn to use these functions in Excel, there are some formulas or some videos posted on the Canvas, and there is a colossal amount published on YouTube for you to look at. Almost too much. So when you're looking for different things on how to use these functions, pick one that's only 2-3 minutes long per function, because some of them go on with lectures for hours. But there's no shortage of things on YouTube to figure out how to use these particular spreadsheet functions, which will make your life a lot easier for this class. So, factors. When I talked about, I'm going to go back a couple of slides. Don't let me get dizzy. This factor, P equals F, P slash F. F equals P times F slash P. Well, these factors are here. This is a scan of page 643 of your text, where you have 8%. It gives you all sorts of compounding factors for any given situation for 8% calculations over n periods. So FP, find F, the future value, given the present value. At 8% over 1 period, 2 periods, 3 periods, 4 periods. Again, n will vary. If it helps you think about it in terms of years, use years. That's usually the default. Unless you're told otherwise, you think about it in years. Books usually does that. It doesn't always say, it says years, but it usually means years unless it says otherwise. You've got to look at the context of your questions. So if you want to find the future value given your present value, okay, well, you'd multiply, if you have $5,000 at 8% today, you multiply it by 1469 to get the future value, given that you have P, the $5,000 today. Well, at 8%, 5 years from now, you multiply that $5,000 times 1.469, and that will give you your future value. Trust me, those are an example. Oh, they also have everything for all different types of stuff. We'll talk about gradients, but I hate gradients, never had any use for them, but it's an old textbook thing that everyone still talks about. Present worth, find the present worth of an annuity. Remember, annuity is a set given number of payments for a given period of time. Find future given annuity. Find an annuity value given F, given you P. You might have a present value and say, okay, I have $5,000 today. What's that? Is that equivalent to how much money per month over this many years? It's like a good mortgage calculation. So, formula, notation for calculating your future value. Future value of a present value of money is equal to 1 plus I to the nth. You saw that. That's a single payment compounding factor. The function value is here. You can use that functional notation from that book place. $5,000 is equal to the future of a present value at 6% 10 years. Don't want it dimensionally correct, that'll confuse you. But you also use the same formula for future value. This is a lot of stuff on the page here. Let's do a calculation to show you what it means. So here is that same $5,000, 8% 5-year world we've been talking about. Now then, I already talked about how if we put it into a future value formula and we stick in 8%, 5 periods, payment of 0. Oh, by the way, if you don't put anything in, it always assumes you mean 0 in Excel on these formulas. And the present value is $5,000. It gave us 7347. Now then, or you can go to that page at the back of the book and use that 1469 factor and multiply that same $5,000 times 1469, and you get 7345. And this is where there should be a gasp at the back of the class when everyone says, oh, but they're not the same. True. They're off by $2. That's because the book stops at 3 significant digits here. Excel goes on for like 40. unless you tell it otherwise. I actually have mine set down to, I think it doesn't do more than 6 significant digits, because otherwise it takes too much calculation on big things. So I look at that future P, F, given P, F, given P. You're given P, being told it's $5,000, and you multiply it by that 1.469, that gives you 7345. Difference here is rounding. If this went on more, this is actually, I think this actually goes to 4, I worked it out once, 46932, something or other. So if you had this going off for extra digits on the table part, it would be more close to the future value. For our purposes, treat these as equal. This is why I always say in homework, show me your methodology so I understand how you got what you got. So here's 2 different ways of doing it on this page. You can put it into Excel on this formula and this function, or just multiply it out here. So, calculating a present value. Here we're trying the future value, given that we had a present value of this. You can do this, if you were just given this 7347 and said, I'm going to pay you $7,347 in 5 years. You say, well, what's the equivalent now of money today? Well, you do the same type of thing. Those PF factors in Excel. Here, okay, I've got 7347. Assuming someone just said, hey, I'm going to give you, if I give you $7,347 in 5 years, what will you give me today? Well, the equivalent of seeing that in 5 years is, you can either work out, do the math on this baseline calculation to create the factor, because 7347 divided by 1 plus 0.8 cubed, or to the 5th, actually this part of the formula, this section 1 over 1 plus I to the nth, equals the factor. That's where these numbers come from. They do it a summation series and come up with this. So 0.6302. So if you multiply that 7347 times 0.6302, it gives you the value of that 5-year payment of 7347 in today's dollars, which is 5,000. Ooh. In other words, we get back and on these. Actually, that should actually be up here. Another typo. We should actually have there. 2 typos. That's what happens when I change additions. So you'll actually multiply that out to get the backwards calculation. That's why if you have trying the present value of something in the future, you're reducing that amount. That's why these are all less than 1. Because greater absolute value in the future means a lower absolute value in the present. Just says, okay, in the future, we're going to compound, we're going to increase the amount of the basic dollars over here. So if you want to do these calculations backwards, this is the exact same type of version I did for future value. In this case, I'm saying, what's the present value of a future payment of 7347 5 years from now at 8% interest with no interim payments being made? Well, you stick the future value in. This looks almost identical to the present value or the future value one we had, except in that one, the previous example, this said future value, this said present value. This time, we're putting in the future value and asking it for the present value. So we stick in this 7347, which is actually 7346640384. So it's not as far off as that manual calculation as we thought. And then when you hit enter, it'll put $5,000 here. Now then, one thing to note here is the sign changes and how Excel uses things. It looks in this negative here and positive here because it's saying if I pay out $5,000 today, I will get back a positive 7347 in the future. And so that's where these signs, it will automatically give you a negative sign because it always assumes that, well, if I'm going to get money in the future, that's a positive money I'm going to get. But to get that money in the future, I'm paying out or decreasing my money today. And so that's why you'll see it automatically puts in a sign change when you calculate it, because assuming if you're getting positive money in the future, you're having to pay out. So think in terms of you're getting it versus giving it. You're giving away $5,000 today to receive 7,347 in the future. So that's why you get these negative items in. That's why it's so critical to make sure when you do those timetables with dollars we talked about earlier, to get your signs right. Is it money you're paying out today and money you're getting back? Money you're paying out today needs to be one sign, being negative. Money you're getting in over time should be positive. Make sure my dad would say your goes inters and your goes outers have the right sign. You're getting money in, whether in terms of real money or in terms of savings, versus paying money out. That's critical. So all these functions are out there and they all have similar elements to them. Again, we just showed you the name of these, but when you look it up in Excel, they all have a rate. The only one that doesn't have a rate is the one that's asking you to find the rate. Because you could use those same stuff if you had 7,347 in the future value and a present value of $5,000 and number of periods of 5, you could put those bits in here, in that same example, and it would tell you that that is an 8% rate. In order to get from $5,000 today to 7,347 in the future over 5 years, this function will give you that 8% back. So if you get a question about, oh, what's the interest rate on the amount of money you put in when you get so much money out in the future? So, and it works both ways for future value and present value. Number of periods. Again, this is for those, how long will it take to pay back $10,000 today at 5% interest? No. How long will it take to pay it down to 0? This will give you those number of periods, years, months, whatever. Last part, we're going to get nominal, effective, and interest rates. This gets important. The annual interest rate without considering the effect of any compounding. So it might say, oh, it's 12% a year. Cool. But if they say it's compounded monthly, well, that's monthly. There's 12 months in a year. So you divide about 12% by 12, which means every month you do a 1% calculation for that money you've borrowed. So nominal interest rate divided by the number of interest compounding periods. Well, if you have a 24% interest rate over 1 year monthly, 24 divided by 12 is 2. So every month you can calculate 2% interest on those calculation by calculation periods. And that's where I say you match up your rate plus period. Make sure you're using your interest rate per period, not a nominal interest rate. So effective interest rate is given by this formula. Oh my goodness. Nominal interest rate divided by compounding periods. 1 plus that ratio to the compounding periods. Now then, this is why when you go out and buy a car loan or mortgage or anything, they always have 2 rates. Your nominal interest rate and a compounding interest rate. One of the reasons you see that on your loans is because Congress said so. Because they figured so many people are getting built by not knowing what they're really paying. You get something that says, oh, 5% interest rate. That looks great. Until you find out they compound it hourly. That's a lot different than 5% compounding yearly or monthly. The compounding period, how often you compound it, is important. Loan sharks love to do this on there. You go to a store, those payday loans sometimes places, and that's why there's so much regulation around them. Because you might go in there and say, hey, yes, I'll lend you this money. Sure, they'll give you a loan to the next payday, 5% interest. Sounds great. Until you find out they compound it daily over that month. And you get yourself in the hole really fast. Credit cards work the same way. So this is why the compounding factor, pay attention to that number of periods that you're compounded over and the interest rate, and make sure you get those synced up. If you have an annual nominal rate, but you have to compound it, make sure you don't divide it by the number of compounding periods. So you get those on an equivalent not to use that term, but equivalent time frames when you do your calculations and stick them in. The book has a pretty good idea talking about that. So, nominal effective interest rates. Nominal rate. Okay, a credit charges 1.5% every month. What are the nominal and effective interest rates? Well, the nominal rate is equal to 12 times 1.5% times, which is equal to 18% per year. This is what I say. Oh, what are you paying on your interest rate on the credit cards? Oh, I only pay 1.5%. Until you say it's compounded monthly, and the effective rate over the whole year you're paying is 18%. If you're paying that high, shop around. So the effective interest rate, well, the effective interest rate is actually higher because that involves the compounding factors. So we already know the nominal rate is 18% because we pay 1.5% per month. So that's the 18% is what we're doing because we pay 1.5% per month. But it's compounded. Every month you calculate that 1.5% on the previous month's interest and principal. So effective interest rate, 1 plus 0.18, that 8.18 there is that 18%, 12 months a year to the 12th minus 1. So in reality, you're paying 19.5% or 19.56% a year. So the nominal rate may be 18%, but because it's compounding, and we know that compounding is more expensive than simple interest, you're actually paying 19.56%. That's why when you see loan applications, they have it in big letters saying what your effective interest rate is, nominal interest rate, annual interest rate. They'll often use annual in terms of nominal. That's not technically correct. That's how the nomenclature banks are required to do by Congress. And it's because of this, jumping between 1.5% to 18% to 19.56% is why you get these loan applications that have these spelled out in big letters that you have to initial that you saw them. Congress says they have to do this because so many people are getting bilked by thinking I'm getting a great deal. They told me I had an interest rate of 1.5%, but it's compounded monthly, which means overall I'm paying about 19.5% a year. So this is why it's good to understand where you are on these calculations. So nominal and effective rate, believe it or not, there are calculations for nominal and effective rates. So we can do it two ways. If you want to know what your effective rate is, well, you can use a future value calculation. Just stick in $1. So your interest rate is 1.5% over 12. That same 1.5% we just talked about, which you pay every month. And it's 12. Why? Because there's 12 months in a year. Not paying anything on it internally. You just put in $1. And that'll give you a future value that of that $1 you pay out today, they get back 1.196. That 1.196 is 19.6% from the previous example. This is one way to get there. Just say, what's the future value of $1 at the end of the year if I get 1.5%? Loan sharks don't want you to know this calculation. But if you don't want to use that, there is another function out there in Excel where you can find the effective rate if you have the number of periods and the nominal rate, 12 periods, 18%. You stick that in and it will spit out 19.6%. That effect is effective, the effective interest rate. And that 9% is actually 19.56%, which is exactly what we showed on the previous example. I know this is a lot, but pushing this to make Excel your friend. So that's what we've got for today. I will be posting some office hours this week, so that if you want to get together with me, I'll say I'm going to post one on Wednesday and Thursday for just for an hour, completely optional. And if you need help, but this is a very important chapter. Don't let it be, because we're not going to give up these concepts. All right. Hope you're having a great holiday. I'll talk to you later.